All right, welcome everyone. Welcome to the Tuesday night trade findings and adjustments. And I'm going to go through a little two-part series so that you guys understand what I'm doing and why in my trading. It's pretty important to understand a couple key facts that if you never understand what we're going to go over today, you will never be able to have exponential growth in your portfolio. So if we're talking about portfolio growth, we've got to start off with what is normally expected. So what is the quote unquote normal expected return in the stock market? Key point, what is it? What does that equal? When we're talking about normal expected return in the stock market, what are we talking about? Average percent return on the S&P 500. That's the benchmark. That's what we're all going against, the average percent return on the S&P 500. Now, there's a key word there. Average, right? Averages are not your friend. Someone please tell me, what is the average of the S&P 500 since World War II? That's typically where it goes to, right? 7.75, 7.8. You're in that same range. You're thinking of 7.8, right? So let's do the math. You put $100 in, right? And after a year, you're going to have $107.08 times itself, which is 1, plus 0.0775. So you multiply it times itself, right? Plus the growth. And I'm just going to use 7.8. That's the better one to do. So let me do this over again. 107.8 for your first year, right? So your second year, you're going to multiply it 1.078 times 1.078. And you come out to 116.20. And that's your second year, right? And then if we keep going through, 116.20 times 1.078, your third year comes out to 125.27. You multiply that times 1.078, all of a sudden you're at 135.04 times 1.078. Here's your fifth year, right? You're at 145.57. Multiply that times 1.078. All of a sudden, you're at 156.93. Multiply that times 1.078. All of a sudden, you're at 169.17. Multiply that times 1.078, and you're at 182.36. And you multiply that by 1.078, and you're at 196.59. But let's do our math. Year 1, year 2, 3, 4, 5, 6, 7, 8, 9. Can someone please tell me, how do you double a portfolio by compounding your average rates of return in 7 years or 7.75? Again, our first year, it grew by 7.78. Second, third, fourth, fifth, sixth, Right here, you're told it doubles. 7, 8. You don't even double until you're into your 10th year. So if you have any money sitting with someone that talks about averages, average rates of return, you really need to say, hey, with all due respect, in fact, don't even say with all due respect. Just say, hey, the math doesn't add up. And more importantly, it has taken 20 years to double your portfolio in the market. I don't have any clue why someone goes back to the 50s. My comment when I heard, well, the average rate of return is 7.75, it's like, wait a second. Who the hell do you have that it matters by the 50s that started putting money in the stock market? 50, 60, 70, 80, 90. You're telling me they're what? 70 years in and you're going back that far? Going back to 2000 is plenty. And in 2000, the real rate of return is about 4.75. Oh, but the S&P, hey, dumbass, you take the losers out of the S&P 500 at the end of every year. Oh, but with dividends, whoa, you don't reinvest all those. I mean, your fees kill you. If you don't understand averages are not your friend, you'll never make it in the stock market. Rule number 2, it's simple. If you are in a fund of any kind, you will not beat the S&P 500, period. Let's title that, period. Let's say you pick the one of the S&P 500 that creams the S&P 500, and on average, it beats it by 2% every year. Why will you still not beat the S&P 500, period? Why will you not beat the S&P? There we go. I love it. Because the fees aren't included in the posted or average rate of return. I love it, Dave. Great job. And William, yours came just a little bit past that, but yes, you're some of my newer guys, so you understand. This is the premise to understanding you have to do something different to receive exponential growth returns. I'm going to go one more time, and I can't make it any easier to understand than this. Story of the dollar. Your dollar increases by 50% and then decreases by 50%. It happens all the time. It happens through, if I go back up to my chart here, it happens all the time in little different time periods where for right here in this year, up and down, it happens in this time period. It happens in this time period. It happens in this 2 years. Maybe it's a 5 year. It happens in this 2 years. It's happened in this 3 years. It happens all the time. You just had a 0% return. And the key word in there, I'm going to go ahead and do it this way. Average return over a 2-year, 3-year, 5-year, 7-year, 8-year period of time. And how much is your dollar worth? Because you are led to believe that the dollar is still $1. It's a 0% return. Haven't lost anything, haven't gained anything. On average, the dollar went to $1.50 with a 50% return. And then the $1.50 went to 75 cents with a 50% loss, and we aren't even counting the fees. Your 0% return is a 25% plus loss in your account. How do I know if I'm in a fund? You can't own 5.7656 shares if you aren't in a fund. Anytime you see decimal points of shares, you are in a fund. If it says fund, some funky name, ETF, the Wilshire, the Hurley Investments Van Fund, you are in a fund. It is that simple. If you are in a fund, you will never beat the S&P 500. In fact, I'm going to say you won't probably even keep up with real rate of inflation. The problem, when you lose money, it takes even more to get it back. No one can beat the Hurley Investments return because of 2008. In 2008, most people were down 40%, even though it was only 38. Most people were down between 40 and 45%. We were up 8% to possibly as much as 18. When you add this onto the fact that it might take 80% to get back to break even, there's no way people are going to get 100% return while we make nothing. The neat part of understanding exponential returns is not necessarily how we're doing it, but what is an exponential return? Think about that, right? Your question is, what is an exponential return? Well, if your chart looks like this, right? It's going, it's going, it's going up, it's going up, it's going up. And at one point in time, it goes, shoots through the roof. You will never get this in a fund. It does not exist. But what is an exponential return for us? It is adding more shares by using the profits of protection. And that protection is the long put, right? Let me work numbers for you. What happens here? What is an exponential return? Well, last year, the market was up 14.44%. And I can go back to the PowerPoint because a couple of these are pretty neat. This, by the way, this PowerPoint has been recorded and it's actually on My Hurley Investment. Go to myhurleyinvestment.com and you'll see it right on the very top. You guys can all watch this if you'd like. When the market was down 28.86%, this particular portfolio was only down 8.4. We had made up roughly 20% of this portfolio on the downward movement, which down the road, we stay apart, and at one point we get exponential returns from the stock market. And this particular account, it's almost at 20%. We're only about 17% higher, but that 17% was not by making more. That 17% was made by hedging in the downside of a market. For real returns and real money, this was $795,000 on a $1.6 million portfolio. Little bit different here. But look at how the exponential returns occur at a later date. The difference here of that 16%, you add it on to the 14.44, we're actually beating it by a little bit. I'm going to do one more. $97,000 return there. Look at this one. This one is 12% when it's down 28. That we take over to right here, and then all of a sudden it squeezes and it doubles. Explain to me the doubling as we go through the year. And that is what I'm going to finish off with tonight, is that doubling, how you truly get that exponential return. I'm going to use last year. It could be during a year, but if the market is up 14.44% and you made up 20% to the downside, simple mathematics makes that a 34.44% return. You might have 20% more shares of stock than the fund buy and hold, right? You've got them by 20%. The next year, it happens again, right? And I'm just making this up. 14.44%. And you still have the previous 20% that you made 20% of that downward movement, or you made 4% on. Well, actually, that's not true. So let's do this different. We're going to go easy. We made half of that downward movement up, right? So you still at 20% that you make half of that downward movement. So that's only another 10%, right? Plus you make that 20% down on everything else that's there, because that's what we did the year before. When you total them all up, 14.44 plus your previous 20, making up half of that, that's an extra 30%, plus the 20% you made on the way down, and all of a sudden your return is sitting at a 64.44%. And then next year, the market just goes up 10%. There is no pullback, right? You have a 10% gain on a 1 point, well, the neat thing is you add these together for the year. You add that and you add that. You basically have a gain on a 10% gain on twice as much as everyone else has. In this particular scenario, it's like 8.88 or 200% return. Last point I'm going to leave you with before next week we show you how we're creating these returns to the downside and how I use the long call as a stock replacement strategy, trying to use the house's money. The last part to understand here, and if you have any questions, start to type them in. In a 60-40 moderate asset allocation, a time horizon, a retirement fund, a target dated fund. In any of these, you will never beat the S&P 500. And it's simple math. 60% stocks and 40% bonds. And let's be honest, that bonds is somewhere between a 3 to 5% return, and I get 3% the first year. If you have 40% sitting in something that nets you 3%, on average, you will never beat the S&P 500. Will it be helpful in 2008? Hell yeah. 60%, let's do the math, right? A 38% down year means 60%. 60% is down 0.38, so is down 22.8. So that part down 22.8, which equals your stock position is only at what, 38.2. And the other 40%, the other 40% is, let's do that, right? The 40% bonds, I'm going to go on the high side, makes 5%. So that's going to be equal to 45. 45 plus 38.2 is equal to 45 plus 38.2 is equal to 83.2. You only lost, 16.8% in that year. Still requires a 43% growth on only 38.21% of your portfolio just to get back to break even. On all the up years that you have, you only make 60% of that upside movement. Take a quick peek at it again on our chart. On every up year, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16. Were we up last year? So this one's probably not correct. 16. On 80% of the last 20 years, it was impossible for you to beat the S&P 500 because you had 40% sitting in a damn bond fund that's netting you somewhere between 0.5% to maybe 2%, even on a 5% gross return. Does that not mean that you are quite happy? And you should have been happy in that one, in that one, in that one. Definitely here, right? Of course. But for 16 years, you were nowhere close to being the S&P because you only had 60% invested in something that 96% of the time couldn't match the S&P 500. I would like for you to soak this in, but these are real numbers. Part 2, I'm going to go over what we're doing to counteract the downward movement, how we're getting these percentage returns for this exponential growth, and how you've also seen me use the long call as a stock replacement strategy to what I'm really trying to do is use the house's money to continue to leverage returns for you into the future. That is part 2. I appreciate you guys being with me tonight. I look forward to seeing you. Take care of yourselves. Be safe in this COVID world. Bye-bye.